You bought the camera, you bought the lights, you bought the laptop. But the way you deduct them could literally save or cost you thousands. Let's talk about it.
Your creative genius deserves the same precision behind the numbers.
Welcome to Let's Get Fiscal,
hosted by Anastasia, Myiesha, and Danielle.
Part of the women-led team at Coterie Tax.
From smart tax moves to cash flow strategy,
we decode everything it takes to run a thriving creative business
so you can scale with confidence and sleep easy at night.
Press play and let's grow your business.
Okay, so we are back, and today we are going to talk about depreciation. And I get this a lot because people say, okay, let me spend all my money. What are the big purchases that I can make to help decrease my profits and decrease my taxable income and, all of that and kind of waterfall of information. But there's a couple different ways that you can do it. And I think this is another situation where we have a bunch of different definitions and verbiage and things that I think we can really dive into and talk about. Sometimes they are used really interchangeably because in a lot of situations they can get you to the same spot.
Gotcha.
But there is a little bit of nuance to them.
So there's different methods, different things. Okay, cool. Well, let's jump into it. So what are a few of those methods?
So when you purchase an item,
yes.
So we're looking at products that, are going to last more than a year. Hopefully you have requested a safe harbor exemption so that you don't have to identify every single item. So there is something like you can make basically a request saying, hey, I know that I'm purchasing items that are going to last more than a year, but they're so low cost that it would be more work for me to be able to track all of these items. And so as long as you make that, then you're really only looking at some of the high dollar items. So it's normally about $2,500 or more. So that way, if you go and you spend, maybe $500 on a little iPad or something, you don't have to track and figure out what happened to that iPad for the next 10 years, and all of that fun stuff. And I know there's just different little pieces of gear where you're saying like, okay, my microphone, that's going to last more than a year or better, but I don't want to have to write down every single piece of equipment that I have. So that's where that safe harbor comes into play. So once what that safe harbor allows us to expense it immediately. It goes on the profit and loss. We don't have to claim it. And we're not worrying about this bonus depreciation, Section 179, all of that kind of fun stuff. So normally in my firm, I set the threshold at $1,000.
Okay.
So if you have one item in particular that was more than $1,000 when you purchase that, and you're taking into account the purchase price, shipping costs, sales tax, things like that. So the complete purchase of the item, and sometimes even like there's installation fees, because we're really looking at placed in service items. So we'll get to that too. Because we're just
I was like, you're giving me a lot of words here. Okay. So over 1,000.
So yes, I'm looking at anything over 1,000. I want to know, what is it? Give me a little bit of a description, because we're going to report that a little bit differently to the IRS, because that is going to be pretty significant. And again, the key there is that it should be an item that is used over multiple years. So a laptop is a really great example of that. And so that's where depreciation kind of comes into play. It's recognizing that you have an item, you're going to use it over the next few years. So you get to take a deduction for how much of that value you've used in that year in particular.
Okay.
So if you're saying my laptop is going to last for 5 years, then I'm going to take the cost of the laptop, kind of divided by 5. There's a whole bunch of other stuff.
Yeah.
I
assumed it wouldn't be that
really.
simple. Yeah.
Yep. And then that's kind of what you take over the 5-year period.
Okay.
Just kind of generally speaking, that's on your accounting books, that's what they'll generally do. But on taxes, we have this maker system that's going to, weight it differently.
Okay.
So that's really what depreciation is we're taking an item, we're recognizing that it's going to last more than 12 months, and we are deciding how much of this item are we using each year, and that's our deduction that we're able to take. And so that's when it spreads out. And, there's different classifications for different items,
Okay.
So you really have to be careful about what is its use purpose, what type of item is it. So a car has a different depreciation value than a cow, because livestock.
You said a cow?
A cow.
Okay.
Yep.
I misheard. No,
No.
you're actually talking about the farm animal. Okay,
Yes.
okay,
Yes. Yes.
I didn't know you could depreciate cows, but
You
okay.
can.
So livestock is it?
Absolutely.
I did not know that.
Absolutely. So because you're thinking you're purchasing a cow, you're milking the cow,
got
and
you.
you're
Yeah. Never considered that. Yeah.
Yep.
Mhm.
So there's even certain things like whether you're purchasing this car to be on a racetrack, is that actually like a vehicle that's used to get you from point A to point B,
Mhm.
or is that more of like a carnival ride kind of thing?
Gotcha.
So
Okay. Yeah.
so everything really has a different
Like category can potentially fit in.
category.
So
And
making
then
sure.
based on that category that it
Mhm.
falls into, you are pre-assigned the life of that product.
Gotcha.
So,
Okay.
like a lot of times furniture, they're assigned a 7-year
Mhm.
classification. So
Mhm.
it doesn't matter if you have it 10 years, like some people have had tables that have been in their home,
Yeah.
generations.
Yeah.
So you have to pay attention to what kind of classification you're looking at and how long this product will last. And then that's where you get it separated out by year.
Okay.
So, when you're doing that, there are ways that you can speed up that deduction.
Okay.
And a lot of times, we talk about the time value of money
Mhm.
when we're
Mhm.
doing that. So even if it's the same dollar amount that you're expensing
Yeah.
over the 5 years, the time value of money kind of says if you're able to get, instead of getting $100 for 5 years, getting $500 in that first year allows you to reinvest it, and
Mhm.
then the actual worth of that money at the end of 5 years is going to be more than if you had just separated it out over
Okay.
that 5-year period. So we
Okay.
see that a lot when we're talking about cost segregations and, like
Mhm.
depreciating a property and things like that.
Okay.
But the same kind of thing happens. And whether you're using that money for investment purposes or putting it into a high yield savings account or just reinvesting in your company,
Mhm.
the idea is if you are able to accelerate that depreciation, you can get all of that benefit today and
Mhm.
then be able to, skyrocket and, further your efforts
Gotcha.
in a much faster way instead of waiting. So there are a couple ways.
Yeah. I was like, how? Yeah.
Yeah. So,
Okay.
I mean, like I said, one of the easiest ones is that safe harbor election
Yeah.
where you don't even have to worry about it.
And you're just doing it all in that same year.
Mhm,
Okay. Okay. What are the other?
You're just
and then splitting
saying
it out?
like, it's going to be, too time consuming and too much
Mhm.
paperwork to be tracking all of these items that are low value. So
Mhm.
with that safe harbor election, we can kind of get rid of some of that.
Gotcha.
Some of those filing requirements. So then we also have Section 179, which
Mhm.
is a certain section
Okay.
of the code that tells us what we can do. And then we also have this concept of bonus depreciation.
Okay.
Um,
So let's break it down. What is Section 179?
so Section 179 allows you to depreciate the item
Mhm.
in that first year of purchase, like the full thing.
Oh,
So,
okay.
like the safe harbor election will only do it, like I said, I do $1,000 and below, just to make
Gotcha.
sure we're, well within that.
it. Mhm.
So with the Section 179, it doesn't matter if it's $50,000 worth.
Mhm.
We're going to
Mhm.
be able to expense it all in that first year.
Okay.
Um, and with bonus depreciation, now that we have the One Big Beautiful Bill Act,
Mhm.
that has reinstated our bonus depreciation. So anything that was purchased after the middle of January of this year, you get 100% bonus depreciation. So in both cases, you are expensing that equipment 100% in
Okay.
that first year of purchase.
So how do you choose what method to use?
So that's kind of where, Section 179 is the traditional method. So a lot of
Mhm.
people will just say, like, I want to make sure I'm doing Section 179. And that's, a
Yeah.
lot of the verbiage that goes around that. But with Section 179, there are limitations.
Oh, okay. Okay.
So a lot of the limitations, Section 179, it goes onto your K1 and there's a limit of the amount of equipment that you're able to expense, but
Mhm.
it's normally in like the $2 million range.
Oh, okay.
So, there's not very many people, especially our client base that we're working with that are
Like gonna
spending $2
yeah.
million dollars a year.
Mhm.
So that doesn't necessarily always come into play, but it is something that you have to think about because it's determined on the individual level.
Oh, okay. Okay.
So it is possible for, especially like a partnership, they could
Mhm.
claim Section 179, and one of the partners might have an ownership stake in other businesses that pushes them over that limitation.
I got
So
you.
that's why Section 179 is always going to be reported separately.
Mhm.
So sometimes I'll see people that have, we call it like the box one income on
Mhm.
your K1, which is your ordinary income. And that'll say, let's say $50,000. And they say, but bought $50,000 worth of equipment and you said we
Mhm.
were going to do Section 179 on it. Why does this number say $50,000
Yeah.
when it should be zero? And that's because the Section 179 is lower on that K1 in a completely separate box because we have these other limitations and they're going to
Got you.
aggregate the Section 179 across all of the businesses that you have. So something to kind of think about,
Mhm.
if
Mhm.
you do have a partnership or an S corporation with multiple shareholders and you're going to elect that Section 179, are any of those people going to be over that threshold and
Mhm.
how does that affect them?
Yeah.
Um, Also, Section 179 cannot create a loss.
Oh, okay.
So it can only bring you down to zero.
Okay. Okay.
And that's really going to be the biggest difference is
Mhm.
that bonus depreciation can take you past zero.
Mhm. Okay.
So that's why we really kind of like it because especially let's say an S corporation, you have a business owner that has reasonable compensation. So that means not only do you have the ordinary income of the business, but you also have your W-2.
Mhm.
So now
Mhm.
you have two sources of income. So if the ordinary income from the business is negative, well, now you start decreasing
From your W-2
from your
income.
W-2.
Ah, so there is some
Mhm.
of that. Okay.
Mhm.
And
Mhm.
you were saying it got reinstated with the latest bill. So that means like it's not always a guarantee that this will be available if the code changes again or if things change again.
Right.
Okay.
Right.
But like
Right.
Section 179
Mhm.
is pretty steady so far, at least.
Mhm.
Okay.
Mhm.
Okay.
Mhm.
So like since
That's
it's
been
here, it's like maybe we should use it if it fits for your scenario kind of thing. Yeah.
right, right.
Got
And
you.
and like I said, there's certain situations where they're just going to be kind of interchangeable
Mm-hmm.
because if again, if you have $50,000 worth of income, but you only
Mm-hmm.
have $10,000 worth of equipment, and you're the only person, then
Mm-hmm.
you don't have to worry about the limitations with Section 179 because you're not earning enough and spending enough to go over that. And then also the deduction isn't going to create a loss. So the Section 179 and the bonus depreciation are
Mm-hmm.
going to kind of act pretty similarly, which is why there's that,
Interchanging with the using of the names. I got you. So a lot of that is for when you can take it all in that same year. But if you expect your next year to be bigger, should you avoid taking it all in the year that you purchased? Or like, how does that kind of go when you have
Yeah,
those?
yeah. And that I see a lot because you can have, especially a business that is very equipment heavy,
Yeah.
that requires a very large investment. And they're kind of pre-revenue or they're, just kind
Mm-hmm.
of building up that client base. They could have a year or two where they're putting in a ton of money into an area. So like even a studio, you have the leasehold improvements and, you have all of these like video walls and, all kinds of things that kind of come into play. So especially if you're crossing over years or you're waiting for things to kind of pick up, you may have losses for multiple years. And you could use bonus depreciation to create losses. And if you don't have any other income that would offset it, because let's say, it's pre-revenue, you're not really making any money, so you can't take out any money. So you're not required to pay your reasonable compensation. And it's the only thing that you're doing. You don't lose those losses. They do carry forward into future years. So once you do kind of go live, then you'll be able to deduct those losses against now your revenue that you're bringing in. But the caveat is you can only use prior year losses to exclude 80% of your profit.
Oh, okay.
So you still have to pay tax on 20%. So, I have seen situations where if you take the depreciation over the 5 years, yes, you create losses in years 1 and 2, but those kind of can carry forward, but then you still have depreciation that will, go further through the years. Versus if you take the full amount and then now in year 3, you're recording all of your profit and all of a sudden you still have to pay 20% tax on it, and you were expecting for all of it to be wiped out because you have this huge carryover loss from all of your efforts before. But then you're like, okay, so why do I still have to pay tax on this money if I have hundreds of thousands of dollars worth of losses that are sitting there waiting to be taken? So those are situations where you might want to say, okay, let's kind of take a look at things and see, does it actually benefit me to take the full deduction? Because maybe you do take the full deduction because even after using the 80% of your operating loss, you still made extra money in profit. But if you think that it's going to be a little bit of a slow build, then maybe taking it all in the first year, it's not really going to benefit you. And then now you still have this like long trail of trying to use all of these carryover losses.
Yeah. No, that makes sense. So for creators, if like they have taken 100% bonus on a camera that they've purchased, but they also use it personally, how does that work when you're using something you've purchased for the business, but also using it for your personal side as well?
So you have to be a little bit careful because there are some rules, about whether you're able to take the deduction when you have personal use. But a lot of it's like everything else is, especially when there is personal use of the item, would you have purchased this item if you didn't have this position? And actually how much are you using it, personally versus business wise? So some of it's just about documentation and is it really actually required for your business? Like it cannot operate without this. And, and you're just like lightly using it personally. You know what I mean? Like if you have a laptop, but it's for work and maybe you like log in and you check your personal emails on it or whatever, like that's not going to be a big deal, especially if you're a graphic designer that uses a computer, like you're going to have a computer in order to do that, so
that makes sense.
A lot of those things you can kind of just track and know, how much it actually is being used personally. I mean,
that's fair.
History. Well, your browser history will tell you a lot of different things.
Yeah, they track a lot.
Okay. So, I mean, a lot of it is just like not going out and saying like, okay, I want to have this item and I'm just going to, it's mainly for personal reasons and I'm just going to like use it once or twice, for business. That's not going to necessarily cut it. Yeah. Yeah. So
That makes
you want to
sense.
make sure that it's something that is 100% just required and that you're able to like easily track how how you're monetizing it. And especially in certain cases, it looks different for different people.
Yeah.
You know, like I always say, like if you're a mechanic, something, you know, like a TV could be a personal item, but it's not necessarily, you know, always a personal item. You can have a TV in a doctor's office and that's going to be business use because it's always there. So, you know, just kind of being aware of some of these items that generally in the market would be personal use. You know, if you are kind of using it interchangeably, you might want to just make sure that you are able to easily point to how you're monetizing it and how it's like 100% required for your business that you have this item.
Okay. So another scenario, what if you purchase your camera? We'll still talk about the camera. You purchase your camera 12/30, so December 30th, but it doesn't get to you until the following year in January. Can you still do that 100% like bonus depreciation? No.
So depreciation, it's really based on, so you brought up like a couple different points there.
Okay.
But bonus depreciation, it's and depreciation of all types is based on the placed in service date.
So you can't.
So it's the day that you can actually physically start using it. So it has to be installed. It has to be, you know, just fully up and running before you can start that depreciation on that product.
Okay.
So that's going to be one thing. And then the other thing as well is most of the time, you're going to be able to get half of a year's worth of depreciation in that first year. So even if you purchased it in December, they're still going to give you 6 months worth of depreciation. The only caveat is if you just like rush out and buy everything in December, now they're going to cut it down and they're going to start making you only take quarterly. So they separate it out by quarter.
Okay.
And then they're looking at each individual item and saying, okay, you bought this in the first quarter, so you get X. You bought this in the third quarter, so you get Y. You know, so you can actually be decreasing the amount of depreciation that you're able to claim overall if you decide to go that depreciation method. So that's why I always say, like, it's not necessarily like, let's go rush out in December and buy everything. Give me a call in September and let's buy everything in September outside of that fourth quarter. And really kind of be aware of that timing too.
Okay, that makes sense. Is there anything else creators should be kind of doing right now before tax season?
I always say depreciation and purchasing equipment and all of these larger items is something that everybody seems to drill into you. Like, go out and buy stuff, go out and buy stuff. But I always say, you know, number one, it's always super easy to spend extra money. Let's do things and recognize what you're already doing and strategies that are already available to you that don't have an additional cost. Because at the end of the day, instead of paying, you know, 30% income tax, now you just lost 100% of the value on something that you didn't necessarily need, you know, that you could have done without. And then also, if you are just looking for expenses, retirement is a really great opportunity for that, because in a lot of cases, there's ways for your retirement planning to count in the exact same way as buying a computer, but it's still sitting in a bank account that's all earmarked for you, that you've set aside for your future, you know, versus going to some larger corporation where, you know, you don't get that long-term benefit from. So, you know, I'm normally not really big into chasing, you know, expenses just to spend money and get that taxable income down.
That's fair.
So,
there's other strategies out there. So Okay, cool.
Yep. So that's where, you know, we want to look at when you're purchasing the equipment. What is your income like now? What do we expect your income to be like over the next couple of years? And then also, you know, does Section 179 or bonus depreciation or just going the regular route of the maker's depreciation work the best for you. And, you can even like run scenario testing to see like what does it actually look like based on your forecasts, and then kind of make decisions from there. So
Nice.
Yep.
Okay, so that should wrap us up. Thank you so much for giving us all of these details.
I think, yeah.
And then we'll see you guys next time. Bye.
Bye.
That's a wrap on Let's Get Fiscal. Ready to stop guessing and start saving? Click the link in the show notes.
Grab your consult and let's make your business work for you.
Not the other way around. You've got this.